We are very pleased to be joined by Ed Morse. He is the global head of commodity research at Citigroup. And of course, commodities, a massive story this year. Let's find out what him and his team and their crystal ball sees for next year. Ed, welcome back to Worldwide Exchange. Great to have you on. Is there kind of one macro theme before we get more micro that you guys have identified for next year?
Yeah, there certainly is. And thanks, Brian, for having me with you today. Last year, we were kind of super bullish. We thought that the commodities were going to lead in terms of dollar-related returns, leading rates, leading credit, leading equities. And of course, that's what happened for 5 quarters in a row until we got to this quarter. So we're looking at a little bit of the reverse of what a lot of people are looking at. It's a year where people are talking about inflation. We're talking about deflation in many ways in the year ahead. We're looking at past a year behind us in which you could throw a dart at a dartboard of commodities and make money almost inevitably. And this year we're looking at significant divergence among commodities. Some are going to outperform and some are going to be really underperforming significantly.
So Ed, is it fair to say that a lot of your competitors, you don't have to comment on them, but a lot of them are calling for like a commodity super cycle next year, wildly bullish. Sounds like you and your team are going your own way on that.
We are going our own way. There are a couple of others, who are in the same path as we are. But yeah, well, we think that neither of the bullish stories is going to pan out in the next year or two. That bullish story is based on the rate of growth that we've seen of demand, particularly for energy, continuing through 2022, 2023. We think this is related to recovery from a recession, of a very deep recession. So it's been a remarkable recovery, but it's going to come to an end. And we think that people who are saying that there's going to be tight supply because of lack of investment are failing to take into account the extraordinary increase in the efficiency of capital and how much more you can get for much less these days than you could a decade ago.
Yeah, so, obviously you guys cover a lot, but when we talk about commodities, we sort of default to the two biggies, and that would be oil and natural gas. Let's start there. So the IEA out with a report in mid-December basically saying that there might be more supply than demand in 2022. They sounded a little bit more bearish on oil. It sounds like you guys would you consider yourself bearish on the price of oil?
Well, it depends on how you define bearish. So the IEA doesn't give you prices. We do. We have Brent averaging $75 for the fourth quarter of this year and $62 a barrel for the fourth quarter of next year. We have the spread between Brent and WTI widening. I call that bearish if you think of it in percentage drop from 75 to 62.
But still, you don't see oil prices here or in Europe collapsing.
Well, no, we do. I think when you go from 75 to 62, that's an extraordinary drop. If you're talking about Europe, where we have double-digit, over $30 through most of the fourth quarter of 2021, we've had gas TTF pricing in the $30-$35 per million BTU range. We have that at the same time next year under 10. We really think that the supply side is going to overwhelm what's happening because of the bottlenecks in place this year.
That would be very good news for many of the consumers in Europe, because we were in London broadcasting in November and talking about the risk of not having enough juice, enough natural gas or other types of power, as certain things didn't work out and the weather got very cold. Do you see that lasting in the next few months of early 2022? Because if so, it could be a very tough, very dangerous, and very expensive winter for Europe.
Sure. December of 2021 seems to be ending with natural gas inventories at the kind of 62% level across the European Union. And of course, the UK is a little bit special for a whole bunch of reasons. But that's very low for this time of year. If we have January weather that's going to be cold and February weather that's going to be cold, we're going to see the maybe 30 some days of forward cover of inventory that 2021 is going to end up with being relatively low. So who knows how high gas prices could go. We have the experience really of last winter in the United States, late winter, early March, when we had an Arctic air mass hitting Oklahoma and Texas. And it's important to remember, right in the heart of gas production, that Oklahoma saw $999 natural gas in early March, and just south of it in Texas, it was in the $850 level. So, we know that Citygate Boston is not normally at $100, but it's not abnormally at $100 for a week of a cold spell. In Europe, the situation on the inventory side is so tight that a prolonged cold spell could see who knows how high prices could go. There's no way to predict it. So they're not going to be out of the danger until we get into late February and see where the weather is and where inventories are at the end of the winter season.
And per megawatt hour, electricity prices are at record highs. I mean, they're literally off the charts in Europe. Leave us with some ideas and some opportunity heading into the new year. Obviously, we heard your views on oil and natural gas. What is your team bullish on, and how do your clients make some money in 2022?
Sure. So we are basically bullish on a bunch of metals. These include the PGM groups, palladium and platinum. They've suffered because of the supply chain problems. The auto industry, when it rebounds on a global basis, will confront fundamental shortage of both platinum and palladium. Aluminum is just a buy because of a whole bunch of things, including the closing of smelters in China, the largest producer of aluminum in the world. We're seeing both in Europe and in China, due to the high cost of electricity, energy-intensive industry being shuttered, either voluntarily or unwillingly, depending on where you are. So we are, bullish aluminum going to well over $3,000 a ton, and similarly, we're structurally bullish copper. We think that it's there for the long run. We think the copper supercycle story really does exist, and we're out for buying dips when it comes to copper.
Wow, big call there on the metals. And if anything, one takeaway, at least for my family, we're going to be stocking up on Reynolds Wrap heading into the new year, if your call on aluminum is right. Ed Morse, Global Head of Commodity Research at Citigroup. Love your views. Have a happy new year, Ed. Thanks for joining us again. Best to you and all your team, and thanks for what you do.
You too. See you next year.